Hello and welcome again to another installment of Economics with Tully. This is Thom Simmons, Professor of Economics and Business, coming to you from my home office in Shelburne Falls, Massachusetts. The topic of today's video is taxation. And we're looking at taxation for two reasons today. First, if you've seen my video lecture on production, on gross domestic product, we know that there's a direct correlation between the amount of production that a society does and the actual wealth created within that society. There is a connection between what we're making and the number of people who are employed and the incomes they're receiving. However, the amount of income that you actually have to spend, your personal disposable income, is not the same as the amount that is spent on the goods and services created. And that's because before you get a chance to actually spend your income on discretionary items, some of that is taken away in the form of taxes. And so in the most simplistic of models, our gross domestic product is reduced by the level of taxes we pay, leaving us with a certain amount of personal disposable income. And so therefore, whenever we're looking at economic measurements across a society, understanding the types of taxation, the levels of taxation that the citizens experience becomes an important component in understanding how wealth translates in that society to personal well-being. So that's the first reason we're looking at taxes. The second reason we're looking at taxes is when speaking to the general person on the street, I find that there is actually a lot of non-understanding, of misinformation about what levels of government tax them for what, and what that money is used for, and what makes one tax different than another. So today we're really simply going to paint a broad picture of different levels of taxation in the United States. In general, there are three levels of taxation to which citizens and/or corporations may be subject. There is the federal level, the state level, and then the local level. In addition to having three different levels of taxation, or three different levels from which taxes may be levied, taxes can be categorized as being one of three different types. There are progressive taxes, proportional or flat taxes, and regressive taxes. And an income tax can be progressive or it can be proportional. There's different combinations of types of taxes, levels of taxation, and how they're characterized. And we're going to try and go through each and every one of these to give you a sense of how taxes impact you and your neighbors. The highest level of taxation is, of course, the federal government. The United States federal government takes in an enormous amount of money each year from taxes. But 91% of the revenue that the federal government takes in comes from a single category of taxes. And those taxes are called payroll taxes. And they're called payroll taxes very specifically because they are based on the payroll of individuals. What's really interesting is that for the first couple hundred years of our country's existence, the Constitution did not permit the federal government to impose payroll taxes on individuals. They could only assess taxes to the states proportionally. And then, with the beginning of the 19th century, the 16th Amendment to the Constitution was adopted that permitted the federal government to tax individuals directly. And that actually changed the structure, the functions, the income levels, and the expenditures of the federal government from that point forward for the last 100 years. Because that was adopted in 1913. At this point, 91% of the federal government's income is taken in through these payroll taxes. And payroll taxes can be further divided into three different types of taxes, and I'm sure you're familiar with all three of these. The personal, individual federal income tax that you have due on April 15th every year, Social Security tax, which you pay as a percentage of your paycheck as you work, and corporate income tax. These three types of income or income-based taxes, as I said, make up 91% of the federal government's revenue, even though they couldn't even do this. They couldn't even tax these things until 1913. Now it is what makes the federal government run. Now, having said that, let's look at the individual income tax. The individual income tax in the United States is characterized as a progressive income tax. And what that means is, the higher your income goes, the higher a percent of your income you pay in income tax. I'll say that again. The higher your income goes, the higher a percent of your income you should be paying in taxes. This is why we have something called tax brackets. Someone may ask you, what tax bracket do you fall into? Or does a certain amount of income push you into a higher or lower income tax bracket? Well, these income tax brackets change every time Congress decides to change the law. But for income earned in the year 2011, if you had taxable income of up to $17,000, you pay 10%, or you will pay 10% of your income in taxes. Now, I specifically said up to $17,000 of your taxable income, because as we know, people have deductions and certain offsets to the income they make, which reduce it below what their actual paycheck, their annual paycheck is. But if your taxable income is anywhere up to $17,000, you pay 10%. Now, if you earn between $17,000 and $69,000, you are in a different income tax bracket. And by the way, I am giving you the figures for married couples filing jointly. These numbers are, these cutoff points and these brackets are different for single people or for heads of households, which might be a single parent with 2 children or something like that. And it's also different for married couples who file separately. So the specific numbers are something you really ought to check with someone who knows taxes. You can research yourself at irs.gov for tax rates, and very often other sites on the internet will carry federal income tax rates. But if you were between $17,000 and $69,000 and you're married filing jointly, now you're paying 15%, a 15% marginal rate. Now, here's what that means. It doesn't mean that you're paying 15% on all of your taxable income, and that's an error that many people make. We call these marginal tax rates because you only will pay the 15% on the excess over $17,000, which is the cutoff for the bracket. In other words, you would pay 10% on the first $17,000 of your taxable income, and then 15% of anything you made over $17,000 and under $69,000. It's everything, it's 15% of what's in that bracket. Once you go beyond $69,000, between $69,000 and $139,000, you are now in the 25% tax bracket. And you will pay 25% of that income, between those two figures, in federal income tax. Between $139,000 and $212,000, it's up to 28%. From that point up to $379,000, it's 33%. And then the highest tax rate for individuals, once you go over $379,000, is currently 35%. So 35% of anything you earn over $379,000 goes to the federal government in the form of income tax. It doesn't matter whether you make $380,000 or $380 million. From that point forward, you're paying 35% of that money to the federal government in income tax. Now, that actually, historically, is rather low. As recently as the 1970s, the upper tax bracket was 70%. You paid 70% of your income if you were in the highest tax bracket to the federal government in the form of federal income tax. This was the case from the 50s through the 60s through the 70s. Only with the 80s did we see some major changes in our income tax structure that reduced the progressive nature of the income tax. It's still progressive because, or still considered progressive, because there still are these tax brackets, and as you make more money, you move into higher tax brackets and pay a higher percentage of your income. So most people would still characterize the federal income tax as progressive. Having said that, there are some techniques, some approaches used within the income tax structure which suggest that it might even be less progressive than we think it is. And there's two features of income tax in particular that I'd like to raise to show you how sometimes it's simply not as progressive as we think it is or want it to be. The first is in the notion of deductions. Your taxable income is reduced by the amount of deductions that you may be able to take on your income tax form. So, if we have two people who each earn, or let's say two couples, and they each earn the same amount of money. They each earn, each family earns $100,000, which would therefore put them in the 25% tax bracket. Right? Two different families. One of those families is fortunate enough to own their own home. In owning their own home, they're paying a mortgage. And mortgage interest is deductible. Now, if they've just purchased the home, if it's a brand new mortgage, most of what they're paying is interest on that loan. And it's all deductible. So that means this family making $100,000 might have $12,000 in deductions to come off of their income tax. And that means even though their taxable income may have been $100,000, they get to deduct $12,000 off of that. So now their taxable income is only $88,000. Take our second couple, also earning $100,000, but this couple was unable to get a mortgage, or this couple is living in a rental home. They do not have the benefit of having an asset or anything that's going to increase in value over time. Rent is not deductible on your federal income tax. So two families, each may be paying the same amount for housing, each earning the same amount. One will be taxed on taxable income of $88,000 because of the mortgage interest deduction. The other is taxed on the full $100,000. And the irony here is a progressive income tax is supposed to help those who have lower incomes and tax at higher rates those who have higher incomes. And yet, because of the mortgage interest deduction, which politically is probably the single most popular deduction on the federal income tax, because of that, it means that those who actually may be wealthier because they own appreciable assets such as real estate actually get taxed on less income than those who have been unable to acquire those assets and are renting. So there's one place where having we say we have a progressive income tax, and yet it doesn't necessarily always work that way. A second area where the income tax is not particularly progressive is in looking at the types of income that are taxed. The rates that I quoted to you earlier were all based on earned income, on wages, on going to work and earning a paycheck and then totaling it up at the end of the year, figuring out what income tax bracket you landed. But we know that not everyone makes money from wages. Some people make money or earn income by investing in stocks and bonds, by holding them a few years and then trading them at a higher price. This type of income is called capital gains income. It's not earned income. And capital gains income is not taxed at the same rate as earned income is taxed. In fact, this has been changing a lot in recent years. From 2003 to 2012, capital gains income was only taxed at a rate of 15%, period. Now in 2013, that's scheduled to go up to 20%. But still, if we look at this again as one family earns $100,000 because they are working, they are a firefighter, a nurse, a plumber, a teacher, a manager in a restaurant. If their taxable income is $100,000, they're going to land in the 25% income tax bracket and pay 25% on everything between $69,000 and $100,000. Another couple makes the same amount of taxable income, but they do it through buying and selling stocks in the stock market. That's considered capital gains. And recently that's only been taxed at 15%. It's going up to 20%. So what we see here is that there's kind of a disconnect. The tax code actually punishes working for a living at a job where you earn wages and rewards income earned through the trading of stocks or bonds or other investments that count as capital gains. Now, there are some who argue that this is a good thing because it encourages people with investable funds to invest in new businesses with the hope that those new businesses will expand, will create jobs, and will help the economy overall. And it is argued that those people who put their money in that type of environment are taking a risk. And the reward for the risk is to be taxed at a lower rate because you could lose everything. The counter-argument to that would be that most people who have capital gains income are not investing in companies at all. Here's another area where sometimes people get confused. They think if they buy stock, if they open up an Ameritrade or a Scottrade or an E-Trade account and they buy stock in a particular company, they sometimes mistakenly believe that they are paying money to that company, that the company is receiving that money. They're not. When you buy stock on the open market, you are not giving a single penny to the company. You are instead paying the person who is selling you that share of stock. This is trading between shareholders. I buy from Joe, who bought from Jane, who bought from Jill, who bought from Jose, who bought from Joaquim. None of this money is going into the company. The only money that went into the company as an investment was the original initial investment that was made when the company first offered stock for sale in order to raise funds. From that point forward, when stocks are traded on the stock market, not a penny is going into those companies. There is no investment being made in that company from those transactions. So in essence, if you buy stock and you hold on to it and do nothing with it, and have nothing to do with running the company and nothing to do with investing in the company, but then you trade it down the road after you've held it for the right amount of time and you make a windfall profit, you are taxed at a lower rate than if you spent all that time working for a paycheck. There is something inherently perverse about that situation in the minds of many people who see that they're getting taxed at a much higher rate than millionaires who are making their money through capital gains investments. So, that's the federal individual income tax. It is claimed to be progressive. There are many arguments to be made that would suggest it is not as progressive as we think, and in some cases may not be progressive at all. Another form of payroll tax is the Social Security tax. The Social Security tax is not designed as a progressive tax. In fact, the Social Security tax is designed as a proportional or flat tax. 7.65% of all of your earnings are taxed. Actually, let me rephrase that to be more specific. All of your earnings are taxed. They're taxed at a rate of 7.65% on what you earn. So the person making $10,000 a year has a 7.65% Social Security or FICA tax. The person earning $30,000 a year has a 7.65% of that as a Social Security tax. The person earning $80,000 a year is taxed 7.65% of their income for Social Security tax. And that's why it's called proportional. The rate does not change as you earn more and more. There's no brackets. It's a flat tax up to a point. And here again is where some would argue that it really isn't proportional, because you are not taxed Social Security tax for any earnings over $106,000. Once you earn over $106,000, the Social Security tax ceases to apply to you. And that means the person earning $90,000 spends 7.65% of their income in Social Security tax, but the person earning $200,000 is really, in total, only paying about 4% of their total income in Social Security tax, because once they earned $106,000, Social Security tax ceased applying to them. So it's a flat tax, but only up to $106,000. The third type of income tax in the federal level is the corporate income tax. And the corporate income tax is also ranges between 15 and 35%, depending on the amount of money that the corporation made, up to a point. And anything over 18 million is taxed at a flat 35% rate. So, ironically, the corporate tax rate at the highest level is exactly the same as the individual tax rate at the highest tax level, 35%. These three taxes together, the individual federal income tax, the Social Security tax, and the corporate income tax, comprise 91% of everything the federal government takes in. As for what the federal government spends this on, generally they spend it on something we call transfer payments, which are payments to individuals, Medicare payments, Social Security payments, retirement payments, block payments and grants. That's actually the number one category of federal expenditures, are these transfer payments. Close behind that, in the current environment, would be military spending, which is much higher than it has been in the last few decades, and the interest on the national debt, which I will go into more in my video on fiscal policy. But we pay a significant amount of tax dollars on the interest on the federal debt alone. That's a snapshot of your federal taxation. Moving along to state taxation. Because we have 50 different states, we have different tax systems in every state. As an overview, let me say this. Most states, 38 states in fact, rely on two sources of income: a state income tax and state sales taxes, taxes on goods that are purchased within the state. Now, at least 41 states have a state income tax. All right? 38 have both an income tax and a sales tax. 3, Delaware, Montana, and Oregon, have an income tax and no sales tax. 7 have a sales tax and no income tax, and they would be Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. And then there are 2 states that have neither an income tax nor a sales tax, and those are Alaska and New Hampshire. But the majority, as I said, 38, have both. Whether a state's income tax is flat or progressive is obviously up to that particular state, and each state has their own system. In the Northeast, Massachusetts has a flat income tax. In Massachusetts, you determine your taxable income, and then, as of last year's tax rates, any individual, regardless of the amount they made, paid 5.3% of their income in income tax to the state of Massachusetts. By contrast, the other states in the Northeast that have a state income tax, Maine, Vermont, Rhode Island, Connecticut, New York, New Jersey, Pennsylvania, these are all progressive tax structures. So it's similar to the federal system that way, in that the more you make, the higher a percentage you pay in those marginal amounts, because you get bumped up into higher tax brackets. Sales tax. Now this is a new topic for us here, is a tax on something you buy. And there are some people who argue that sales taxes are inherently regressive. We haven't looked at a regressive tax yet so far. A regressive tax is one in which individuals pay a higher percentage of their income in tax as their income goes down. So the poorer you are, the less you make, the higher a percentage you pay in tax. And there are some who argue that sales taxes are regressive. And here is why. Let's take 2 people. We'll take Alan and Barry. Both of them are interested in buying a particular Harley-Davidson motorcycle. They are just in love with this particular model. Alan goes to the store and asks, how much is it? And they tell him it's $20,000, and they tell him the tax on that bike is 10%. Well, if Alan's going to buy that bike, he's going to pay a 10% sales tax, and 10% of the $20,000 ticket price would be $2,000 in taxes. Now, Alan makes $100,000 in income. So when he pays $2,000 in tax for that bike, he's paying 2% of his annual income in tax. His income was $100,000. He paid $2,000 in tax. That's 2% of his annual income. That's Alan's story. Now, Barry comes along. Barry also wants that bike. Price of the bike is the same to Barry, $20,000. The tax on that bike, 10%, is the same to Barry. So he will also pay $2,000 in tax. They paid the same amount. But Barry only has an annual income of $10,000. So if he's paying $2,000 of his $10,000 annual income in tax, he's paying 20% of his income in sales tax. So that's an extreme example, but that's why some would characterize sales taxes as regressive. Because if two people are buying the same thing, they're paying the same amount of tax, but the person with the lower income is paying a greater proportion of their income in tax than the person with the higher income. Of course, the counter argument to that is that people with lower incomes shouldn't be buying expensive toys like a $20,000 Harley Davidson or a luxury boat or an expensive car. And in fact, most states that have set up sales tax schemes have attempted to exempt goods that lower income people need to buy. So very often, things such as groceries in the store, clothing, pharmaceuticals are not subject to sales tax. So things that lower income people are most likely to have to purchase, they're not getting hit with the sales tax. Whereas if you're buying more and more expensive toys or meals out or expensive vacations, you are getting hit with the sales tax. And that's an effort to keep it from becoming a regressive tax and hitting the poor more directly. Although there are taxes, and you can probably think of some, that do hit the poor more directly. Electricity, gasoline, taxes that many lower income people feel they must pay because you need to have lights on in your house and you need to be able to drive to work to make the low income you're making. Those are often considered regressive because the lower your income, the greater amount you're paying in taxes. Now I mentioned that 38 states have both income and sales tax. There's a handful that have one and not the other, and then there's two that have neither. Alaska has a tendency to depend on royalties from oil companies doing drilling. Those royalties go to the state and fund the state treasury. In New Hampshire, the state runs the liquor business. You cannot sell liquor privately in New Hampshire, and so the state profits. The state makes a profit from that business. In addition, there are some other taxes in New Hampshire, such as interest and dividend taxes, and as many other states, meals taxes and accommodations taxes and gas taxes, tolls on certain roads. They use this to fund the government, and New Hampshire has a tradition of not having an activist government that is not well funded and does not engage in a lot of services for the population. That's the culture of the state. And in fact, their legislature gets paid a grand total of $200 per person, rather than having full-time, full-salaried legislators in the State House. It's a different culture in that state. Lastly, let's look at local levels of taxation. Now, certainly in some places, there are cities that are allowed to enact taxes. New York City is one of them. But as a general rule, the basic form of taxation for local governments across this country, in just about every state, is the property tax. Now, when we talk about local government, we're talking about townships in New England and New York, Wisconsin. We're talking about counties in almost every other state in the United States. Local governments across this country raise the vast majority of their money, of their revenue, from property taxes. And property taxes are almost always designed or structured to be a certain rate times a certain assessed valuation of the property. There's two parts to this formula, and it's important to understand both parts. Let's look at the second part first, and that's the assessed valuation of your property. In many places, perhaps even most, the assessed valuation of your property, or of a piece of property, is not the market value of the property. And this is an error that many people make. They see a tax bill and they see their property has an assessed valuation of $120,000, and they say, wait a second, this house could only sell for $90,000, or wait, this house would sell for $200,000. Why is the assessed valuation $120,000? And that's because local governments cannot go by market fluctuations, which are constantly changing. And of course, the market value of your house is going to be determined by the market for your house and negotiations between you and a buyer or you and a seller. So they need a much more objective criteria to use to determine the assessed valuation of your house. And very often, the assessed valuation of a house, as determined by a local board of assessors, will be based on objective factors such as the square footage of the house, the acreage of the property, the number of bedrooms, the number of bathrooms, the number of outbuildings, the number of permanent improvements like decks or in-ground pools, things like that. And it's all done according to formula. And that determines the assessed valuation of your property. At that point, most towns or counties will determine what the total assessed valuation of the entire town or county is, and they will come up with a budget and figure out how much income they need to run the town or county for the next year, and this includes school districts. And then they will simply make a calculation by dividing what they need by the assessed valuation of all the properties, and they will come up with a rate. So for instance, a typical rate might be, in the town of Kinderhook, the property tax will be $20 per $1,000 of assessed valuation. I'll say that again. We're going to pretend in this fictitious town of Kinderhook that the property tax rate is $20 per $1,000 of assessed valuation. So, if your home or your property has an assessed valuation of $200,000, what that means is you knock off the last 3 zeros. What you're left with is 200, and you multiply the rate of $20 times 200. What you end up with is a property tax bill of $4,000. And that's how property taxes are determined pretty much across the country. Sometimes I'll ask people what their property tax rate is, or I'll even ask a government official what the property tax rate is in the town, and they'll say something like, oh, it's 12%. That really is not an accurate way of answering that question. 12% of what? The best way to phrase property tax, whether you're a government official or someone looking to understand the property tax rate in the town you are looking to move into, is a rate per $1,000 of assessed valuation. And so you need to know both assessed valuation and rate. If two people are having a conversation and one's saying, oh my gosh, the rate in our town is crazy, it's $25, and someone says, oh, the rate in our town is only $13. That doesn't mean the second person's necessarily paying a lower tax, because you also have to ask, well, what's the assessed valuation of a 2-bedroom, 1,000 square foot house? Both parts of the formula are necessary in determining what the property tax bill will be. Now, we said for the federal government, the number one source of revenue are payroll taxes, income, Social Security, corporate income, and the number one expenditure are transfer payments back out to people, as well as military and interest on the debt. Our states are collecting revenue from a variety of sources, but mostly state income tax and estate sales tax. And they're using it for the general purposes of life, for your roads and your state police and your prison systems and your university systems and traffic control and conservation in waterways and tourism and basically all of the stuff of life. But the local government, the number one source of revenue across the country is property tax. And the number one use of local revenue across the country in every state, in every county, in every town, in every city are public schools. In the United States, the public school system is notoriously locally controlled, locally operated, locally funded. And that is very much a unique facet of the American tax system. Now, there are mechanisms to try and reduce property taxes for people with very large pieces of property like farms or open space. That's not going to be the subject of this video. I will be producing another video very specifically on using tax and regulatory policy to try and preserve farmland and large unbroken woodlots. But I don't have time to go into depth in that here in this video. Let's end it there. That gives you an overview of taxation. We are now 41 minutes into the topic, and I hope that's clarified some issues that may have been misunderstood or cloudy for some of you. Thanks, and have a great night.